Good morning, ladies and gentlemen. Let me first of all wish you a very happy and prosperous New Year. Of course, it's my sincere wish and hope that year 2013 will be a good year for the global economy. This morning we have a very special and the best guest speaker who will tell us all about the global economy and the US economy in particular. Dr. Alan Sinai has been with us around this time of every new year during last almost 20 years. As you know, Dr. Alan Sinai is the most respected and trusted senior economist in the world. He is best known as economic forecaster and financial market analyst in the United States and throughout the world, in fact. You know, economic forecasting is rather hazardous business, but he has been around in that business more than almost 40 years. He has been awarded, he won various awards for the accurately forecasting the economy and the financial markets. His works spans various fields, not only in academics, but business and government consulting and almost every field where economists can contribute much. He, in fact, consulted closely Reagan administration and senior Bush administration and junior Bush administration and the Clinton administration. He frequently advised Federal Reserve Board and Central Bank of Japan and has actually been very actively involved in consulting the governments and central banks in most advanced countries. And we are very fortunate that he is always with us very early New Year. As I said, the last almost 20 years. And he has been very the famous and actually he was a leader in macroeconomic forecasting models, building macroeconomic forecasting models. In early days in his career, he worked with the well-known economist Otto Eckstein, and he worked at the DRI. As you know, the Professor Lawrence Klein, who is Nobel Prize winner, led the WEFA, but Alan Sinai and Otto Eckstein led DRI. And here we are. And actually, he got lost this morning. He had a free breakfast at another meeting. He had free breakfast there, and then he just joined us. Well, with no further ado, and please join me in welcoming Dr. Sinai.
Thank you very much. I'm delighted to be here, as I have been for almost 20 years. Time flies when you're having fun.
Yeah.
Korea, you have been so gracious to receive me this way at the beginning of most years, and hopefully I've been of help looking ahead on the major issues of the day. I did learn quite a bit about the economy of Korea from my prior meeting a few minutes ago in the sapphire room. And I know sapphires aren't emeralds. By now I know that. And how I got there for breakfast rather than here, I came from a different place in the hotel than usual and asked where the emerald room was, and I was showed into a room with a crowd of people about this size. The lady put a name tag on, which was in Korea, but I thought that was okay. And they sat me down at a table where not much English was spoken, but I learned about the businesses of the people at that table, and they are not so good. It's mixed. It's mixed. And I think I have a brighter message for you today for the year ahead in the next 2 years than what I heard at the briefly at the table where I did have my breakfast. The outlook for the global economy for this year and next does look better than it did when I spoke to you a year ago. Let me briefly summarize how the U.S. prospect after the election looks, the world, and the major risks that slowed the world economy and the U.S. economy down last year. And for the world economy, as we follow it, analyze it, and forecast it, gave us, for the global economy, almost a recession. 2.1% real GDP growth for the global economy. That's 47 countries, 93% of global output. The dividing line between, for the world economy, growing and decline is 2%. We were very close to a global recession last year. The U.S. disappointed and rose in real GDP terms only 1.8%. We don't have the fourth quarter in yet, but it's going to be a fairly weak quarter, maybe 1.5% growth. Europe, the Eurozone, and then Europe fell into a recession. It's widespread. It still goes on. That damaged exports of Asia. Europe is a big customer of Chinese exports, South Korean exports, and China's slowdown, engineered by China. The policymakers of China have wanted the economy to slow down and inflation to come down. That damaged the South Korean economy and the economies of all of Asia. China, as you know, the second largest economy in the world. And Japan fell back into recession. So between the Europe recession, the Japanese recession, and the slowdown in China, that was the heart of the weakness in the world economy that gave us global growth of a little over 2% as against the 2.5% forecast that I came here to talk to you about last year. The whys of this, WHY, why this, in the U.S., still adjusting to a lot of structural impediments that have prevented a massive amount of policy stimulus from lifting the U.S. economy. In the Eurozone in Europe, the recession there came from a multifaceted crisis. weak trade, weak growth, banking problems, a crunch, policy actions of austerity in order for certain countries to deal with their budget and debt problems. And for China and Asia, a purposeful winding down of the boom in the Chinese economy, which had gotten out of control in terms of Chinese inflation, 6.5% at one point, a couple of years ago. And so the Chinese policymakers reined in the Chinese economy. We have, over the last 3 years, seen a 5 percentage point decline in Chinese economic growth. And if you're dealing with the second largest economy in the world, that's going to have a big impact on the major trading partners of that country, in this case the countries of Asia, particularly South Korea, and create an impetus for slower growth in the world. Now, as we come to this year and look ahead, for the three biggest economies of the world, the US, China, and Japan, the picture is brighter. We are over the decline in growth. And the look ahead for these three countries is for higher growth, and then through trade, export and import flows, and assuming, this is an assumption, that the downturn in Europe bottoms out, the global economy should do significantly better in 2013. For the global economy, that's 47 countries that I mentioned we cover and forecast, we're projecting 2.5% to 2.75% real growth. That's better than about 2%, but it's not nearly so good as the initial lift out of the economic and financial crises a few years ago, and it isn't for the global economy up to historical standards and trend, but it is better. And this prospect has as major ingredients two that are non-U.S. One is the outlook for China, where it does appear on the data the Chinese produce that a soft landing has been achieved. By that I mean Chinese real economic growth has come down from nearly 12% year over year to something a little over 7% year over year. That's a 5 percentage point drop in growth over the past 2.5 years. It's a change in the growth rate that sets up substantial business cycle dynamics. That deceleration had major negative effects on the economies of Asia, ranging from Japan to Indonesia and Malaysia. But that growth decline is over. The data are clear. The Chinese economy is picking up. The data are somewhat tentative. It's only 3 or 4 months. But in the process of the last half year, Chinese economic policies, rather than being restrictive, have turned toward stimulus, so that the Chinese economy very likely has bottomed out and will grow faster over the next year. We are estimating about 8% year over year, maybe as high as 8.5%. no lower than the growth rate we see now, which is 7.5% or a little less year over year. That's significant. Rather than a decline in growth, growth will pick up some. And that shift in Chinese economic growth will reverberate through exports and imports all over Asia, so that the major trading partners of China will see their businesses stabilize and improve. That includes South Korea. In Japan, the third largest economy of the world, where we now have a recession, deflation, huge deficits in debt relative to GDP, sluggish consumer spending. The picture there is changing in a very significant way. One reason is the declining yen. The second is the change in leadership in Japan. We have all known for a long time that the Japanese currency was overvalued on the fundamentals surrounding the Japanese economy and societal outlook. 20 years of weakness, 2 lost decades for Japan. Growth sluggish on average, at best 1% to 2% a year with occasional lifts. Japanese fiscal policy, in my view, has been mistaken. One spending project after another without any lasting impacts on the economy, but certainly causing higher deficits and debt relative to GDP for the country. But central to a turnaround in Japan and then a better Japanese economy affecting the countries of Asia and the world is a lower currency. And so, finally, for various reasons, the Japanese yen has started and is in the process of a major downtrend. The fundamentals of the Japanese situation suggest on economic grounds and currency valuation grounds a yen dollar that should easily be well over 100. The yen dollar stands currently at 87.88, in the range of 87 to 88. Its peak was 75 to 76. And the move in the yen down against the dollar and other currencies, including the South Korean won, has been quite sharp over the past 3 to 6 months. The process of a move toward a more appropriate value for the Japanese currency, given its economic and societal fundamentals, in my view, has only begun. And now that the motion of the currency is in process, financial markets will take the currency down even further. For the Japanese financial markets and economy, a lower currency for Japan will be helpful. A weaker Japanese yen against the South Korean won will not be helpful on competitive grounds for Korea, nor for other Asian economies where exchange rate differentials make a difference in exports and trade. But I think it is written in the wind. It is in what goes on when currencies are overvalued. Economic, financial, and political developments are converging so that, on our view, fundamentally, over time, the next year or two, we expect yen dollar to move to well over 100. That means the yen will be lower against the euro. It will be lower against a managed Chinese currency. And it will be significantly lower against the yuan. For those here who are in export businesses, this is a situation that you need to watch. You need to redouble efforts to keep the cost of production down as you try to sell more around a world economy that is improving. A stronger Japanese economy, levered by a weaker currency, will be helpful to overall demand and volume of sales in Asia and for the world economy because of the size of the economy of Japan, which is third in the world. Businesses will feel the competitive pressure of that lower currency, but the volume of sales around the world should be better. The way something like this works is once a currency begins to move down when it has been overvalued, in the financial markets, the stock market will rise as, looking ahead, financial market participants anticipate better exports and a better economy, and as time goes by, higher inflation. In its early stages, higher inflation means rising prices for what is produced and sold by a country, and it means higher profits. Revenues go up. Higher profits, in turn, induce businesses to spend more, and more people are hired, and the economy picks up. That is the process as we see it of a turnaround for Japan, where the economy currently is in a recession. This is 6, 12 months, 18 months down the road. At this moment, the Japanese economic data say recession, but it is going to turn this year and lift economic growth, as will the Chinese pick up all over Asia. And together, in the forecast we have for this year, a better Asian economy, including Japan, will in turn help the exports of Germany and Europe, contribute to a bottoming out of the European downturn. All of that together will help the U.S. at its exports as world demand picks up. But for the United States, exports are just 12% of real GDP, so this improvement is not decisive for the United States. The motive force for a better U.S. economy this year will be the American consumer, around which fundamentals are improving very slowly, but improving. So aggregate consumption in the United States, we think, will be in the 2 to 2.5% range. That's 70% of the U.S. economy. We're projecting U.S. economic growth at 2.25% or 2.5% for this year. It's more optimistic than most. And the U.S. modest pickup in growth to 2.25%, 2.5% from 1.75% or so this last year will contribute to more world growth. The global economy is highly interrelated, more so than ever before. And all of this, a lift in Asia coming from better times, a better economy in China, a better Japanese economy that will turn probably in the second half of the year and in 2014, and a somewhat better U.S. economy. That's the story of the better global economy and better times for South Korea that I have for you at the start of 2013. Let me turn a little more specifically to the United States and the U.S. Economic and financial situation and the political situation after the election. When one steps back and looks at the United States, a number of countries in Europe, the European economy, the Japanese economy, many of the advanced economies of the world, what you see is, from a longer run perspective, what you see is slow growth. What you see is advanced economies with major problems, legacies from the past, high deficits, a lot of sovereign debt, and the need for fiscal restraint. The need for fiscal restraint to reduce the deficits and the growth of debt relative to GDP. Well, we have all said for years that deficits and debt in the aggregate for a country ultimately are unsustainable is now showing up in the anemic growth of the U.S., of the Eurozone, of Europe, Japan. This will stay. It will be a long period of time for these countries of working out from under the accumulated deficits and debt for so many years, and for many of the countries, the government support in the form of government outlays for the society that so many of these countries have engaged in and in part caused so high deficits and debt. In a number of the countries, part of the government support, income transfers, programs of government outlays has been because of aging populations and the demands of those older populations on the system of support and system of health care and the costs of that. These are structural demographic issues, very prominent in the U.S., very prominent in Japan, also present in Korea, situation in Europe. And governments had tried to respond by providing a lot of support. That's part of the high deficits and accumulated debt. Is not really ultimately for any country sustainable, high deficits and debt. And we are seeing now in the advanced economies, many of them, Germany's an exception, Canada's an exception, the growth lowering effects of these high deficits and debt. In the United States, it shows up in real economic growth that since our recovery began in 2009 has been about 2% a year. It shows up in much less growth in aggregate consumption, 1.5 to 1.75% a year. The American consumer economy is about $11 trillion. The Chinese economy on a dollar converted basis is about $7 trillion. That's the second largest economy in the world. The U.S. consumer economy is bigger than China as an economy all by itself. So that how the U.S. consumer in aggregate goes has major world effects and major effects on many of the businesses of the people in this room, export businesses. The world needs a healthy American consumer to spend money. But the fundamentals around the American consumer are not such, including indebtedness and deficits at the macro level of the economy that will allow consumption to go back anytime soon to its historical trend, which is historical trend, 3.5% a year inflation adjusted. The U.S. consumption economy is growing at 2% a year. Not even quite that. We think it can do that, and will do 2 to 2.5% in 2013. That's better than before, than last year and the year before, but it's nowhere near as good as it was in the old days when, on average, consumption went up, on average, 3.5% a year. The typical economic recovery and expansion in the United States has seen consumer spending rise 4 or 5% a year. The world feels that. Jobs growth, income growth, psychology of the American consumer will not support that kind of growth rate anymore, not for a long, long time. To get a higher growth rate for the U.S. consumer economy and the American economy requires, from the policy side, stimulative fiscal policy and or stimulative monetary policy. We have stimulative monetary policy that's going to continue from the Federal Reserve, but the United States cannot cut taxes and raise government spending anymore to grow its economy faster because we can't afford it. We have had 4 years of deficit to GDP, over a deficit over $1 trillion, and the debt to GDP ratio in the United States is over 100% in gross public debt relative to GDP. In Washington and in the United States, as a response, the movement is toward fiscal restraint. The latest, what we call fiscal cliff compromise in the U.S., involves higher taxes and less government spending growth. The next round of negotiations on discussions in Washington on the U.S. fiscal situation will surely bring more cuts in the growth of federal government spending and may bring some additional tax increases. Fiscal stimulus is needed to raise the U.S. growth rate above 2 or 3%, but fiscal restraint is needed to deal with huge U.S. budget deficits and the accumulated debt relative to GDP. Right now, after the election, the U.S. is in the process of, with difficulty, finding the amount of fiscal restraint to apply to the economy to deal with its sovereign debt problem. That's good from the long run, that the U.S. is coming to grips with this problem. But as all of you know, having been through similar problems in South Korea and Korea at times, and observed such problems of deficits and debt in other countries around the world, the process of dealing with it takes a long time. And during that time, we won't, in the United States, be able to provide fiscal stimulus to the economy to help consumers spend more, any more than, in our view, at best, 3% inflation adjusted, and probably on average 2 to 2.5%. How the American consumer grows really defines and will define the growth path for the United States. The so-called new normal, I call it permanently subpar anemic growth, is dictated by how much in aggregate consumption spending can grow in the U.S. And this is about, in our view, the best it will do. It's better than it has been. China's economy has bottomed out and is turning up. The Japanese economy, levered by a declining yen, later this year should bottom and turn up. 2014 should be better than 2013, and for the world economy, 2013 better than 2012. This, we think, also will be the case for the Korean economy, which we are projecting at 2 3/4 to 3% growth in 2013, as against 2.5 to 2 3/4 growth 2012. As Korea finishes the year, it finishes the year on a low note in terms of aggregate growth. Inflation is low. The currency is strong. The South Korean won is one of the strong currencies of the world, relatively speaking. It is likely that the Central Bank of Korea will reduce interest rates as we move through the year to help the Korean economy grow faster, and also to try to prevent the won from appreciating against the yen too fast. So increased growth, relatively low inflation here, interest rates probably declining, suggest a better stock market for Korea. And indeed, the outlook for China and for Japan suggests that the Asian global region's stock markets will outperform world stock markets, and that there will be a very nice stock market environment over the year. Business will get better and follow that. That's the typical progression of events in the business cycle of economies that are private enterprise to a very degree mixed capitalistic economies. I don't mean capitalism in a political sense, I mean it in an economic sense, which is the case in Asia. Asia, to us, over time, is the most dynamic and will be the fastest growing global region in the world economy, with economic times and the returns on investments higher, relatively speaking, than anywhere else in the world. Turning back to the United States as the biggest economy, and some of the risks around what I would describe as a relatively bright picture for the global economy as a whole, you're not hearing from me as gloomy a picture than probably you've heard over the last 3 to 6 years when I have given these annual talks. There are a number of risks. We call them macro risks. We call them ifs, capital I, small fs in English, ifs. Things that are uncertain, that have to fall into place for the picture I have presented, which I might call the basic prospect, at least it is for us, to unfold. And this year, Washington is at the center of these risks. That is to say, what the United States does on its deficit and debt situation as against the slow growth that the U.S. economy is providing. This is a very difficult problem, policy problem and challenge in the U.S. economy. What the United States has, for a lot of reasons, the huge downturn, the financial crisis, the working out of the financial intermediation system contraction after the crisis, mistakes in macroeconomic policy, in the private sector, a tremendous liquidity preference, desire to hold cash, and risk aversion by households, by business, by financial institutions, unlike anything ever seen post-World War II. All of that is a legacy of the biggest downturn in the U.S. economy and biggest financial crisis that the United States had since the 1930s. It takes time for the adjustments in the private sector to work that out. But this year, as the United States tries to deal with the problems of too little growth, too few jobs being created, high unemployment, that's an economic and political problem, as well as the high deficits, 4 years, $1 trillion plus, 8-9% of GDP deficits, 4 consecutive years, and a debt to GDP ratio of over 100%. From the fiscal policy side, that's what I mean by Washington. Figuring out how to handle that is extremely difficult. The fiscal cliff, which was a somewhat bizarre incentive mechanism set by Congress because they could not agree on how to handle this problem, involved for a 10-year period $7.5 trillion of fiscal contraction. If the fiscal cliff had hit in full force with its $500 to $600 billion of increases in taxes and cuts in government spending for 2013, I would have to have forecast a recession. I would be here today telling you the odds were 50 or 60% that the U.S. would have a recession in 2013 and maybe 2014 if the fiscal cliff had hit. The word cliff, this was coined by a phrase that will go down in history, probably last longer than the memory of Ben Bernanke will last. His phrase, fiscal cliff, referred to the very sharp, cliff-like fiscal contraction that was set by law in Congress to begin in 2013. And the only way to avoid that is to change the law and have the president sign the legislation. Not so easy in any political system to do that. Why did Congress set this trigger, this punishing fiscal contraction on the spending side, on the tax side? Congress did it to provide an incentive to Congress to come to an agreement to deal with the problem, because the alternative of the fiscal cliff would be worse than not dealing with the problem. You know, as an economist, as an ordinary American citizen, this is bizarre. The policymakers, the leaders of our country, set a mechanism to so punish the economy and them in order to get them to figure out a way to come to an agreement. This way of doing it and the process of rationalizing or coming to grips with the fiscal deficits and debt of the United States is part of what makes us, from a global perspective, only overweighting the U.S. stock market a little bit and basically, over the longer run, negative on the U.S. dollar, and on the dollar, ultimately, if we keep on this track of doing the business of America this way in Washington, the dollar will no longer be a major reserve currency. It's a very bad path. Other countries that have had difficulty in their policy making and in the politics have not had a good future in terms of where investors invest and in terms of the ultimate outcome in economies and in their societies. But this is the way Washington did it. And now, having come to a compromise on this $7.5 trillion 10-year fiscal contraction, that certainly, if it had hit, would have put off the sovereign debt problem of the United States for many years, nothing to worry about, because it would have taken down our deficits and debt quite substantially. But at the same time, we would have had, if it had hit in full force, a full-fledged recession. We're stuck in between those two problems now. It's too late not to have the problem. We have the problem. The question is, how do we get out of it? Well, what was done, and the Congress did at the very last minute, the deadline was the end of the year. They managed to get this done on January 1 and January 2, was to fiscally restrain through higher taxes on higher income families by only $620 billion from the current policy baseline. That's not enough to solve the deficit and debt problems of the United States. But it was so little restraint that the outlook for the U.S. economy is better in the near term as a result. The work is not done. It is understood in the United States, in Washington and outside, that the deficits and debt are unsustainable. You will see in the United States a coming to grips with this problem over this year. And you will observe, I believe, very chaotic, uncertain, sometimes market-wrenching interactions in the U.S. economy that will reverberate through financial markets throughout the world, but not very much impact on economies. If the fiscal cliff had hit, $500 to $600 billion of fiscal restraint, higher taxes, think what that would have done to consumption and lower government spending in 2013. And I would have had to stand here analyzing that and call and say we have a recession coming in the U.S., the biggest economy in the world. It's quite clear what I would be telling you about the rest of the world. I would be forecasting more trouble for China, more trouble for Japan, reduced demand for Korean exports going to China and Japan, most likely from the current position of Korea, a move down, weakness as a result of this. I would have had to have forecast a global recession. Washington and how the U.S. works its way through this problem needs to be watched over the year, because if the fiscal restraint is overdone, that will reverberate through the world. If it is not dealt with, the markets will react, financial markets, in terms of the U.S. situation. And hopefully Washington won't do too much fiscal restraint or too little, as the United States delicately, because it is a tough process, finds its way toward dealing with its deficit and debt problem, and at the same time managing to grow at a reasonable rate. This is one of those macro risks for the world. Washington and the deliberations over the year on how we handle the U.S. fiscal situation. It's a very uncertain part of the macroeconomic picture for the future. If Washington does too little fiscal restraint and the U.S. grows better as a result, that will help the world economy in the near to intermediate term, but ultimately the adjustment in the U.S. will have to be made. And that, when it would happen, would be a problem for the world economy. If the U.S. does too much fiscal restraint, that is doubtful But if they were to do too much fiscal restraint, that would be injurious to growth in the near to intermediate term, affect the world economy in the near to intermediate term. But the outlook for the United States in the longer run would be better because of this huge problem that the U.S. faces. The United States isn't the only country facing this problem. Japan also has the problem. Much of the Eurozone in Europe has the problem. Korea does not have this problem. Yes, consumer debt is on the high side here. It is somewhat out of line with income, but that isn't. Korea's economy doesn't have the same parameters, anywhere near the parameters of the deficit and debt burdened number of the advanced economies of the world. China does not have that problem. Singapore does not have that problem. Canada does not have the problem. Mexico does not have the problem. There are many countries around the world that do not have deficit and debt, sovereign debt problems. And we are advising our clients to invest more in those countries than in the countries that have to deal with it. In the United States case, dealing with deficits and debt from the fiscal side means restraint. Restraint means less growth. In the Eurozone and Europe, austerity has been imposed, and that created a recession. Policymakers are not likely to get the dosage exactly right. In the history of policymaking in any country, this is difficult work. We should not expect, as our base case, the policymakers to get it right. We should expect them, in general, in almost any country, to get it wrong first, and then adjustments to the policies be made, and maybe roughly over time get it right. What I'm saying about Washington this year is I am not sure they will get it right. It is a major risk for the U.S. economy looking ahead, and it's a risk to the world economic outlook as I have presented it, one of the major risks. A second macro risk, or if, has to do with monetary policy in the U.S. and around the world. That one is easier. Central banks, the Federal Reserve, Bank of Japan, the European Central Bank, Bank of England, very likely the Bank of Korea, all will be either accommodative on monetary policy or easing policy further. In the current situation, easing or easier monetary policy involves expanding central bank balance sheets. Using balance sheets by a central bank is a new form of monetary policy. The balance sheet is a policy instrument, not just short-term interest rates that central banks typically manipulate. Why have central banks gone to using the balance sheet as an instrument of policy? Well, in a number of places around the world, policy rates have been taken to zero. They can't go any lower. To provide more monetary stimulus if needed requires non-standard, non-typical, non-traditional kinds of monetary policy, and expanding the balance sheet is one of them. This is in its experimental initial stages. But our view is we will see more of this by more central banks around the world where stimulus is needed, especially in those countries where fiscal restraint is being applied. That means the U.S., that means Japan, that means the European Central Bank in Europe, probably the Bank of England. Korea does not have, in our view, a deficit or debt problem, but in order to be competitive on the exchange rate, we'll have to lower rates, so we think we'll see lower rates here in Korea. The use of the balance sheet and what is called the printing of money is very new in monetary policy. It really was started first in Japan, second in the United States. And so far, as we monitor this over the last 4 years, our research view is it is working with very little cost in terms of inflation from printing money. Everyone's reaction when central banks print money, buy securities of various kinds on its balance sheet, is that there will be a runaway inflation. There is no runaway inflation in Japan. Japan has been doing this now, I think, for 5 or 6 years. In Japan, there is deflation. Consumer goods inflation ex fresh food, which is the key indicator for the Bank of Japan, is minus a tenth year over year. In the United States, where we have been doing quantitative easing since 2010, actually began in 2009, 2010. We've had 3 rounds, QE1, QE2, and now what we call open-ended quantitative easing, unlimited in time and unlimited in amount. The inflation rate in the United States is running about 1.5%. In the UK, the inflation rate's coming down. In the Eurozone, the inflation rate's coming down. So far, in reality, the printing of money has not been associated with higher inflation or runaway inflation. We all think that eventually this way of monetary policy will give us too high inflation as a cost. But everyone thought that when quantitative easing started, and it hasn't happened. So I would submit that this is an unknown. This is very new. We don't know. And so long as the inflation prospect looks benign in a given country, what the monetary policymakers will do is to add more securities to the balance sheet to stimulate the economy. In any case, in the United States, this is the major thrust in monetary policy now. And for this year and probably most of next year, central bank will first increase its holdings of securities, U.S. Treasury securities and mortgage-backed securities on the balance sheet, likely to go to about $4 trillion. We think then stop accumulating securities, hold on the size of the balance sheet, and then the U.S. Federal Reserve tells us when the unemployment rate gets down to around 6.5%, we're at 7.8% now. So long as inflation stays under 2.5% on a projected basis, not until the unemployment rate gets a lot lower will the central bank start to take down reverse the process and raise interest rates. On standard paradigms of employment and unemployment, and on the data that we see, it will take a long time for that unemployment rate to get down to anywhere near full employment in the United States. And so monetary policy will be supportive. Zero interest rates, the printing of money to some degree, won't always be $85 billion a month of additional purchases of securities. Monetary policy in the U.S. will be very supportive to growth and to interest rate sensitive areas of activity, which include autos. And in the U.S., we see a very good-sized increase from previous levels of motor vehicle sales, and that should continue. Housing is picking up significantly in the U.S. The traditional big-ticket interest rate monetary policy sensitive areas of spending have picked up. U.S. motor vehicle sales, the demand for autos, very likely will end up this year somewhere in the 15.5, maybe higher unit rates. That is a plus for Japan. That is a plus for Korea because of the importance of the auto industry in that picture. And it will help lift consumer spending. The progress and use of balance sheet policy by the central bank is in its most early stages, never has been tried before in the history of monetary policy. It is one of those uncertain elements in the prospect for the global economy that I have described. But we do think at this point we see signs of it working in one area. Two areas are housing and autos. We've also seen the balance sheets of households improve, not yet fully back to health. That's supportive for consumer spending. That means consumer electronics, consumer discretionary spending in the United States should be better this year than before. The second country where quantitative easing is very prominent is Japan. And there, that is part of the decline in the yen. Zero interest rates and expansion of the balance sheet by the Bank of Japan. We expect that to continue, the expansion of the balance sheet. We are forecasting that the Bank of Japan will move to a higher inflation target from 1% to close to 2%, as other central banks in other countries have done. We do expect the political side of Japan to come forward with fiscal stimulus of the traditional kind. We're not fans of that, but we think that's what will happen. And that the lower yen and stimulative fiscal and monetary policy in Japan will produce not much growth this year, but a lift out of the Japanese recession into expansion next year, and that the Japanese stock market will do very, very well over the year. That the 2 decades, so-called lost decades for Japan on a cyclical basis may be ending. This is a very gutsy call and forecast to make, but I'm older now. I hope I'm around, but I may not be around to see if that forecast works. It is, but you notice I use the word cyclical and not structural, because Japan has incredibly difficult societal problems, mainly the aging population and the nature of the Japanese model of growth and development, which for a time worked but no longer works in the modern era. The last issue is Europe and the Eurozone in terms of risk. At the moment, we cannot see the end of the downturn in Europe. One of the working assumptions we have, and I've mentioned it, of the major macro risks, China does better, Japan turns, the U.S. does better. We somehow work our way through our fiscal problems without doing too much harm to the economy, and Europe and the European downturn bottoms out. On the data that exists now, as we monitor it, Europe, 85% of Europe is in recession. 85% of Europe is a very big economy. It is indeed bigger than the Chinese economy when you put it all together. And so Europe in recession is a big negative for the exports of Asia. We are assuming that it bottoms out. For the Europe downturn to bottom out, some things have to happen. The economies of Europe have to adjust. Financial crisis in Europe has to work its way out. The European Central Bank has to stay easy, perhaps lower its policy rate and increase its balance sheet. The fiscal side of Europe needs to be rationalized. They have decided on an overseer of all the banks of Europe, that's the European Central Bank. But fiscal policy has not been rationalized because it's very difficult when you have 17 countries in the Eurozone and 27 countries in the European Union to come to an agreement and to give up fiscal sovereignty for some central unit that has not been rationalized. The currency is still at risk. And countries that have had collapses like Greece, Portugal, the slowdown, the recession in Italy, one in France, creating a lot of political instability in Europe, the outcome of which we cannot be sure about. This is probably the one macro risk that at this moment has for us the least visibility on how it will work out. For Europe to do better or to bottom out in its downturn requires China to grow more and Japan to turn and the U.S. to do better. It's all interactive and very complicated in the interactions. So take the Europe picture, which is this past year, 2012, down 0.5% to down 1% in Eurozone and European real GDP, and a very long downturn. The notion that it will bottom out and the growth rate in 2013 be plus 0.5%, that is more assumption than forecast. I hope it happens. We will have to see as the year goes by. So, to summarize, the basic prospect for the U.S. world economies, particularly Asia, looking ahead, 2013, 2014, better. Not like the old times, but better. Relatively low inflation, supportive monetary policies. For those countries that do not have a fiscal problem, good for them. They have not spent their way into further problems. We see a division in the pace of growth of the advanced economies, many of them, the US, Japan, countries in Europe, and the growth rates of major Asian economies, particularly what's called emerging Asia, and also emerging Latin America, and to some extent emerging Europe. Definite difference. It's a brighter prospect, and particularly for Korea, as time goes by this year, it should mean better exports, better business, and an improvement in growth with low inflation. But the story of the basic prospect does have a number of risks. China we feel quite confident about. Japan and the effects of the declining yen, which is one of the big changes in the global environment. The direction of that currency, of policy, and the politics of Japan. That's yet to happen. The U.S. improvement, not in the fourth quarter, so it's a prospect. And, of course, Washington will do its dance around the business of America, much to the dismay of so many observers of the United States, hoping that somehow our political system will be able to come to grips with these difficult problems in a reasonable way. But by and large, the forces of the business cycle for the world and for so many countries, after so many problems and troubles of the past, do seem to be working out, albeit slowly, pointing to better times ahead. So I cross my fingers on this forecast, which is for a brighter year, and hope that it actually happens in the next year or two ahead. So thank you very much.
Well, thank you very much for very, very comprehensive and illuminating the coverage of global economy and the U.S. economy and the Korean economy. The bottom line is that this year and next year will be better than the last year and recent years. Although it may not be as good as we really want to be. But in any case, we can expect, although there are various macroeconomic risk factors, we may expect a better year next year. Well, after his free breakfast, he spent almost an hour, So we don't have much time, but we have. I'm sure you would like to entertain a couple of questions from the floor. Yes, Dr. Che and Mr. Speckman. Yes.
Well, Dr. Alan Sinai, thank you very much for sharing your thought with us about global economy and Korean economy. Your conclusion that prospect for global economy, Korean economy, year 2013 is better than what was like last year. And one of your argument about strong Korean won and also possible consequence of interest rate management. But I think there's a lot of concern about Korean financial sectors, about financial stability. Because one factor fueling strong Korean won is a lot of global hot monies are seeking to interest rate differential in the wake of quantitative easing in the US and Japan. So how do you expect this tendency of Korean won strong is likely to continue? And related question, much more serious question is, we have seen in the year 1997 and 2008, strong won and also the inflow of foreign currency, foreign capital, may be suddenly reversed and leading to sudden exodus, and then will be some alarming sign bell. So how do you like to see this outlook and consequences, some possible policy countermeasures? I appreciate your response.
Yes.
Why don't we invite Mr. Speckman?
Jim Speckman, Prudential. I'm hearing from my friends in the U.S. about this fiscal cliff in the U.S., and it seems to me the argument is between the Democrats and Republicans about Democrats want to increase taxes, especially on the rich, and the Republicans want to have spending cuts. And given the debt ceiling and all the things that are happening about that, this has some kind of a political overtone, so I don't know if you want to comment on this extensively, but I'm interested as to how they can go about meeting in the halfway, so to speak. You increase some taxes, you reduce spending cuts. But there is another element that I've been thinking about, and that is the U.S. government size is, obviously I'm a Republican, so the size is just enormous. So you could cut a lot of the departments, congressional size. Even some have suggested that we should cut the number of Congress size in addition to the executive government size. So how much can you eke out the savings by cutting the government, the size of the government, so that you don't have to reduce other benefits to the poor, especially, and also the Congress people, the senators and the representatives, they have completely different compensation scheme, and also healthcare system. Why can they be brought to everybody else, that is Social Security and the Obamacare? If you do that, I think you could save a couple of trillion dollars. So would you comment on that, if there is any possibility of doing it?
Okay, thank you. Although there are more questions since we're running out.
Let me on the yuan versus the yen, but other currencies as well. I think it's so highly likely that the Japanese currency will go down quite a lot that should simply be taken as a given. That's a very aggressive view, but it's long overdue in Japan, and the new government is on this wavelength. The old governments were not. And there will likely be changes at the head of the Bank of Japan, because terms are up in March for the current head of the Bank of Japan, and very likely the government will appoint somebody to head the Bank of Japan who will be who will want a lower currency and will take actions to do that. So the yuan will go up against the yen. And it is against other currencies. This is the non-yuan side of the yuan-yen. That is, from the Japanese side, the forces there are going to be designed to drive the yen down against the Korean currency and other currencies. You need to understand that South Korea, in the eyes of global investors, Korea is viewed as one of the better investments in the world. The country is stable. It is relatively prosperous. The parameters on the Korean deficit and budget are good. Monetary policy has been intelligent. You've had an election here, which is very interesting. Elected a woman, and this is not a country known for that kind of thing. And the education and business savvy of the country is quite good, relatively speaking, and Korea benefits from better Chinese economic growth because of the importance of China as a trade partner for Korea. So for currency holders and asset allocators around the world, Korea is one of those countries, in our case, for example, we recommend as against holding dollars, holding euros, or holding yen. The stories underneath those currencies are not good. Economies in those regions of the world are not good. The policies in those regions of the world have been terrible. The United States, the Eurozone, and Japan. The growth prospects are not good. Societies and politics are unstable. Look at the changes in leadership that have gone on in Europe. Look at the changes in the leadership of Japan over the past 5 or 6 years. Look at the political divisiveness in Washington. Global investors don't really want to put all their eggs in the basket of the dollar or the euro or the yen. Just the opposite. So they look for other situations where countries are doing their business wisely and have a good prospect and buy and hold the currencies of those countries and diversify. So for us, South Korea is one, Australia is another, Singapore is another, Canada is another, and then you sprinkle in some commodities like gold and oil, and you have a diversified basket of holdings as an option to holding reserves or investments in the dollar or the euro or the yen. And even a mixture of dollar, euro, yen is very unattractive because the fundamentals at the moment underneath those economies are so poor. So you need to understand that this is part of the force to push and hold the yen higher. It's not just what Japan does on its policies. And we just think unless Korea, forgive the language, screws up in its policy or its politics, you're stuck. Your currency is going to be preferred across the world as part of other currencies that are preferred. And the policies of Korea will have to figure out how to handle that. Now, one way to deal with it for the Bank of Korea is to cut interest rates. That can't hurt. Inflation's low and the economy could be stronger. We're assuming there will be cuts in interest rates over the year. We don't know, but we're assuming that. That's one way to deal with limiting the appreciation of the currency. Capital inflows is another way to deal with it. What I've just said to you, I hope gives you some insight. I think you already know this, of why capital comes to Korea. It's partly as a hedge against investing in the US or Europe or Japan. And it comes to Korea, and sometimes those capital inflows can be too high. And if the currency begins to rise, you'll get speculative movements of currency into the country. And countries sometimes take actions on capital controls. Historically, that's a mistake. I think you just have to live with the stronger currency in your businesses. Be as productive as you can, as innovative as you can, keep labor costs down to be competitive, and sell like mad in the world, which Korea does. It's a very commercial kind of set of companies we see come out of Korea. We respect that. And that is just the way you have to run the business. And monetary policy needs to get easier to hold down the rise in the yuan against the currency, against your currency. On the fiscal cliff in the U.S., your suggestions are eminently reasonable. I've already sent those to Washington long ago, and it doesn't matter. Washington is dysfunctional. The best I can do for Washington when I'm asked, why does Washington have so much trouble, is to send them my favorite psychiatrist from Cambridge, Massachusetts. You know, the MIT, Harvard area and all these intellectuals in the Boston area, including myself, we need help psychologically sometimes. So I think my answer for Washington is I'll send them a marriage counselor and see what they can work out. And even then, that won't work, because here's the fundamental problem. It's real, and it means that we will fight in Washington until the politics of one side or the other dominates. And you have to live with that in your investments. It is fundamental philosophical differences between Republicans and Democrats, and a political system that allows them to think only about getting reelected rather than whether the policies they take are good or bad for the U.S. economy. And so ordinary Americans, by that I mean people who are supposedly not as know as much as someone like me or someone like you, come up with great solutions down in Washington all the time. Yours among them. Why not save more money in the federal government by consolidation? Why do we need all these members of Congress? For me, this is off the record for the press that are here, by the way. For me, for my tax money, they work for me down in Washington. I would fire them. The Democrats and the Republicans, they're doing a terrible job. If I was on the board of directors of a company and they were performing that way, they wouldn't have a job. But it goes on in our country. And the bulk of Americans are fed up with it. They're fed up with it. I hear from people who are not experts wonderful ideas about how to solve the problems of Washington, but they don't and won't do it. Why not? President Obama, my politics are independent. They're neutral, which is probably why I haven't had a job in Washington, but I've advised both Democrats and Republicans. The latest, the Democratic caucus, the Nancy Pelosi. That's a liberal side of the U.S. situation. Sincere intentions of President Obama are societal in nature. Reduce inequality. I think that resonates here in Korea. We do have tremendous income and wealth inequality in our country that is built up. And to rebuild and to build and take care of the infrastructure of the United States, which includes roads and highways and education. Education, for sure, I'm a fan of spending more money. We don't know how efficient government spending is, but these are worthy objectives. To do that and to provide health care for all Americans, money is needed. And so President Obama and the liberal Democrats come at it on the side of, give me the money, because I have all these initiatives I want to do, but they don't, as business people do, take care of the business, so they run a good business. That's just their background and their training. On the Republican side, where you have mainly business people and financial people, they look at the spending, and it's out of control. It's too high. Spending as a portion of GDP is 25%. Tax revenues as a portion of GDP, 19%. That gap has to be closed. Spending has to come down as a portion of GDP, and revenues go up. That's fiscal restraint. That's what we're trying to work through, and it's very, very contentious. Well, the Republicans run businesses. You run business, you know you must get your expenditures under control. You must get your expenditures under control. You know that free money doesn't come to you from your customers, that you can't go to the markets with bonds and borrow money indefinitely. Business people know that. And so they and I think our big problem is the expenditure side. The expenditure side. We have not dealt with that in this first round of the fiscal cluff. President Obama did very well. He did not give in any ground on entitlements, which is the problem. I'm dealing with it by cutting discretionary spending. Unfortunately, in the U.S. budget, discretionary spending, kind of thing you'd like to cut as a business person, is very small. The big numbers are Social Security, health care, Medicaid. Social Security and health care are wrapped up in the aging U.S. population and their demands for health care goods and services, which are very expensive and costly. Inflation is very high. In order to get spending under control, which includes the mandatory spending or the entitlements, we are going to have to reform Social Security, deal with Medicare and Medicaid. And in a society like the United States, which is not a command society like China, where I was just recently in Vietnam, it's a society where all kinds of opinions come forward, have to be mediated, and the political system tries to deal with it. This is really, really tough. So you should not expect great progress on solving our deficit and debt problems. Some progress on these issues, and it will be imperfect. And certainly taxes, I think, will go up. We hope it will go up through what we call tax reform, closing some loopholes. Economists like me are big fans of tax reform. We don't know. Because once, in my lab with my models, many of you in the audience here trained in economics will appreciate this, I can come up. I'm a madman scribbling in my laboratory with my models, with my glasses, I can come up with the answers. It's Keynes called economists are madmen scribbling in the air that occasionally defunct economists like me are being listened to by politicians. I can solve it. But I have learned that whatever you put into the U.S. political system down in Washington goes through a meat grinder, so what comes out is totally different from the ideal policy that would go in. What is wrong with the U.S., it's not ordinary Americans who have the best ideas. It's not business people. It's not financial people. It's Washington. It's dysfunctional. And until the U.S. alters its political system in one form or another, or figures out how to do this, do not expect miracles out of the U.S. on their problems. I can't do anything about it, but I can advise clients to move their money and capital around the world. And I am advising them this year to invest in a weighting sense in Asia. That includes Korea.
One small follow-up. Despite there is a constitutional amendment that was put in years ago that requires the congressman to be on the same laws and benefit schemes as every citizens. Now, they raise their own remuneration anytime they want to, on their own. They buy their own, they have separate insurance.
Yes.
Medical insurance policies separate from the average Americans.
Right.
Now, how are they allowed to do all these things? And why do people let them get away with it? I mean, they should just vote them out and then put new people in there so that they could come out with the
we vote them out regularly, and then the well-meaning people who go down to Washington to solve the problem become part of the problem. President Obama, and this is also off the record, is one of those. He was elected in 2008 to change Washington. Guess what? He's part of the problem. It's what goes on in Washington. It's like a machine that sucks up everybody that gets involved. The Tea Party, very controversial in the United States. Well-meaning people who wanted to go down and change Washington, they're part of the problem. And so it is an intractable at the moment problem. I can't hold out any promise of it getting any better, only the hope that somehow we will grope our way toward a reasonable fiscal resolution. The one thing I'm sure of is that the Federal Reserve will do its best to support the U.S. economy as long as unemployment is high, and that's a plus. But the fiscal thing is now, as far as the insurance goes, one last comment on that is one of the competing alternatives for health care that's being put out, is to have the kind of health care programs that our Congress people get available to all Americans as one of the options in health care services, and it's part of the discussion around the Medicare situation.
Well, I suppose we can go on like this all morning. 저 취재진들 아까 몇 가지 이야기는 쓰지 마십시오. 예. 그래야 내년에 또 우리 사이나이 박사 얘기 올 수 있도록. Well, I was just telling the reporters that they don't cover what you said.
Some of those things, yeah.
So that we can have you back next year again.
That's right.
Well, thank you very much for sharing with us. Very, very insightful, the illuminating views of yours. As always. But the bottom line is that this year and next year will be better than last year. And also, although strong Korean won will be rather painful for our business community, particularly for trading companies, but somehow we have to live with it because it's a sign of our fundamental strength. And it's a sign of the global recognition of our strong fundamentals. So we have to live with it. I don't think there's many ways to do otherwise. So we have to find ways to live with this. Well, with this, please join me in thanking Alan Sinai.
Thanks. Yeah, you got the best part.